$850 billion. That isn't just a statistic buried in a report. That is a loaded gun aimed straight at your bank account. And as of today, the hand gripping that trigger belongs to China. For years, anyone who warned about a bond market collapse was laughed off as a conspiracy theorist. Experts said it couldn't happen. They said it wouldn't happen. But right now, we are watching the impossible transform into the inevitable in real time. This is not just an economic shift. This is a geopolitical breakup between the two largest superpowers on Earth. And it is going to force a brutal repricing of everything you own. Homes, stocks, debt, your future purchasing power. The 30-year mortgage rate is about to break free from reality. It is going to surge, and there is nothing the Federal Reserve can do to stop it. If you thought 7% interest rates were painful, you are not prepared for what comes next when the largest creditor on the planet flips the table and walks away. To understand why this obliterates your buying power, you have to ignore the surface-level headlines. Most analysts focus on a single figure. They look at China's holdings of standard U.S. Treasuries, which sit around $760 billion, but that number is incomplete. When you include U.S. agency debt, massive institutions like Fannie Mae and Freddie Mac, the true exposure is closer to $850 billion. That is the real leverage Beijing holds over the American economy. This is the nuclear option. For over 20 years, there was an unspoken deal, a symbiotic relationship. China shipped us cheap goods, electronics, clothing, furniture. In return, we paid them in IOUs called Treasury bonds. Then China made a very deliberate move. They took those dollars and recycled them straight back into our debt market. They loaned the money right back to us. This kept U.S. interest rates artificially low. It also kept China's currency weak, allowing them to export even more. It was the greatest financial arrangement in modern history for the American consumer. It subsidized our entire standard of living. But that deal is finished. The trade war of 2026 shattered the cycle. A former partner became an adversary. When the United States imposed 60% tariffs on Chinese goods, we effectively told China their dollars were no longer welcome. China responded logically. They stopped recycling those dollars into U.S. debt. Instead, they started selling. And the data now confirms it. China is dumping U.S. assets at the fastest pace since 2015. This is not random. This is not noise. This is a calculated strategy by a foreign government to de-dollarize its economy. They are selling paper promises and converting the proceeds into physical gold. They have been buying gold for 28 consecutive months. That is a record. They are exchanging claims from a hostile government for an asset with no counterparty risk. They watched what the U.S. did to Russia's reserves in 2022, freezing accounts overnight. China is making sure that can never happen to them. But here is where this becomes dangerous for you. The problem isn't that China is buying gold. The problem is that no one is stepping in to buy the bonds China is dumping. The U.S. government runs on debt. We operate with a $2 trillion annual deficit. That means Washington spends $2 trillion more than it collects every single year. To keep the system running, the Treasury must sell billions in new bonds every week. It's like paying off a maxed out credit card by opening a new one. In the past, China was always there at the auction. They were the guaranteed buyer. Now they're gone, and worse, they're unloading their old holdings into the market. That creates a massive supply shock. Imagine an entire neighborhood where every house goes up for sale at the same time. But there are no buyers. What happens to prices? They collapse. The bond market works the same way. When supply overwhelms demand, prices fall. And here's the rule you must understand. Bond prices and yields move in opposite directions. When bond prices drop, interest rates spike instantly. This is why rates are rising even as inflation headlines claim things are cooling. The market sees the truth. There is no marginal buyer left. The Federal Reserve is tightening. They are selling bonds, not buying. U.S. banks are already overloaded with government debt and sitting on enormous unrealized losses. Japan is fighting to defend its own currency, forcing them to sell treasuries as well. That leaves one buyer standing: you. To convince you to fund the government's spending, they have to offer higher and higher yields. This crowds out the entire economy. It pushes interest rates up across the board: credit cards, auto loans, business loans. But the most immediate impact hits housing. The 30-year fixed mortgage rate tracks the 10-year Treasury yield. If Chinese selling pushes that yield to 6%, mortgage rates mathematically jump to 9%. That outcome is unavoidable. What we are witnessing now is something truly alarming: a complete decoupling. Mortgage rates are divorcing the Federal Reserve. We are told the Fed controls the economy from a command center. That is a myth. The Fed only controls short-term rates. Long-term rates belong to the market. The Fed could cut rates to zero tomorrow. But if China sells $50 billion in treasuries the same day, your mortgage rate goes up, not down. That reality neutralizes the Federal Reserve. It breaks their ability to rescue the housing market. We are entering a new regime. Economists call it fiscal dominance. In simple terms, debt levels now matter more than interest rate policy. And make no mistake, this is war, not with bombs or soldiers, but with mathematics. China understands exactly where America is vulnerable. They know the U.S. middle class is dependent on housing wealth. They know real estate drives the economy. By keeping interest rates elevated, they can engineer depression without firing a single shot. This is asymmetric warfare, and the timing is not accidental. It aligns perfectly with semiconductor sanctions. The U.S. cut off China's access to advanced chips, so China cut off America's access to cheap credit. You block our technology, we block your funding. The difference is devastating. China can survive without cutting-edge graphics chips. The U.S. economy cannot survive 9% mortgage rates, and that collapse has already begun. Look at commercial real estate. Office buildings are already hollowed out. Entire towers sit empty, bleeding cash, unable to refinance loans taken out during the era of cheap money. If foreign selling pushes rates even higher, that becomes the final nail in the coffin. We are talking about trillions of dollars in real estate value evaporating. The U.S. Treasury is trapped. There is no clean escape. They have two options, and both are catastrophic. Option one, force the Federal Reserve to restart the money printer. Trillions of new dollars are created to buy the bonds China is selling. That saves the market, but it detonates inflation. Your grocery bill doubles. The dollar collapses. We destroy our own currency just to absorb debt dumped by a foreign adversary. Option two, do nothing. Let rates rise. Let the system seize. That path leads to a deflationary depression that makes 2008 look mild. This is the trap Beijing has engineered. Heads they win, tails you lose. Right now you're probably staring at your portfolio asking a simple question. If cash is dying and real estate is cracking, where does money go? I'll tell you exactly what survives. But first, you need to understand what's happening behind the curtain. China isn't selling openly. They're masking their exit. The data shows they are using European custodian banks, Belgium, Luxembourg, to hide the true scale of their liquidation. Official numbers say 760 billion. The real exposure is likely far lower. Every bond rally becomes an exit ramp. This creates a permanent ceiling on bond prices and a hard floor under interest rates. The era of 3% mortgages is over. For a generation. For 40 years, America lived on borrowed time and borrowed money. We had a VIP pass to cheap credit. That pass has been revoked. Now we pay full price. And you're the one paying the fee. Higher loan rates, higher credit card interest, higher monthly bills. This is a geopolitical tax you pay every single month. Globalization didn't disappear slowly. It is unraveling in real time. The bond vigilantes are back. But this time they aren't hedge funds. They are nation states. And they are selling to cause pain. That pain is about to hit corporate America. Major corporations gorged on near zero interest debt in 2020. That debt is coming due. Now they must refinance at yields 2 or 3 times higher. Imagine your mortgage payment tripling overnight. That is happening to Fortune 500 balance sheets. Bankruptcies follow. Layoffs follow. The stock market is ignoring this. It assumes the Fed will ride in and save the day. But the bond market sees reality. The Fed is trapped by the sheer volume of debt flooding the system. We are watching a slow-motion collapse in the plumbing of global finance. There used to be a shock absorber, the reverse repo facility. It was a massive pool of cash that absorbed pressure. That pool is now empty, drained completely. There are no shock absorbers left. If we hit turbulence now, the axle snaps. A single violent move in Treasuries could trigger a flash crash. Yields spike. Leverage breaks. Margin calls ripple across the globe. The entire system is fragile, over-leveraged and exposed, while under attack by the second largest player in the game. This is why smart money is moving. Billionaires, family offices, sovereign funds. They see the bond market cracking and they are evacuating the blast zone. They are buying assets that cannot be printed, assets that cannot be erased by keystrokes in Washington. Gold, land, commodities. The old advice is dead. For decades, advisors pushed the 60-40 portfolio, stocks and bonds. Bonds were supposed to protect you. When stocks fell, bonds rose. That relationship is gone. Bonds are no longer the shield. They are the weapon. They are the epicenter of risk. Holding long-term U.S. government debt used to be considered risk-free. Today, it's a bet on global stability. And global stability is breaking down. Look at Taiwan. Look at the South China Sea. Peace is not the baseline anymore. The $850 billion sell-off isn't a future threat. It's happening now. The dollar is being strangled by the same nations that helped build it. To survive this, you must understand the plumbing, and the plumbing is failing. The reverse repo facility was like an emergency reservoir. For 2 years, it held over $2 trillion. When the Treasury needed cash, it dipped into that pool. It allowed massive debt issuance without collapsing the market. That buffer is gone. Now every dollar the government borrows must come directly from the banking system, from bank reserves, from deposits, from liquidity that used to keep the system stable. And the timing could not be worse. China is dumping bonds at the exact moment the liquidity cushion disappears. Banks are scrambling. Regional banks are under immense pressure. You remember Silicon Valley Bank in 2023? That wasn't the crisis. That was the preview. Here's the mechanism. Banks buy bonds with deposits. When rates rise, bond prices fall. The losses are real, but hidden. As long as the bonds aren't sold, banks can pretend nothing happened. But when depositors panic and withdraw cash, banks are forced to sell those bonds. The losses become permanent. Insolvency follows. That is exactly how SVB died. Now that risk exists everywhere, China understands this perfectly. By forcing yields higher, they're widening the hole in bank balance sheets. This is not collateral damage. It is the strategy. Banks are the Achilles heel of the American system. If banks can't lend, the economy freezes. Credit stops. Growth dies. And the Federal Reserve is cornered. Their emergency program, the Bank Term Funding Program, expired. It's gone. There is no safety net left. The Fed now faces a binary choice. Let banks fail or print trillions to save them. Either path destroys the middle class. And this attack doesn't stop at bonds. It's spreading to energy. This is the part that should genuinely frighten you. For half a century, the United States had an unspoken global arrangement known as the petrodollar system. If any country wanted to buy oil, they had to pay in US dollars. Whether France was buying from Saudi Arabia or Japan was buying from the Middle East, dollars were mandatory. That created permanent global demand for our currency. It forced nations to hold dollars and US treasuries. It gave America a magic credit card, one with no spending limit. That era is ending. China is the world's largest oil buyer, and now they're paying for oil in yuan. They've established swap lines. They've negotiated side deals. They are deliberately bypassing the US financial system. For the first time in decades, Saudi Arabia is openly breaking ranks. They're accepting other currencies. The 50-year marriage to the dollar is cracking. This isn't symbolic. This is an attack on what economists call America's exorbitant privilege. We've been able to run massive deficits because the world needed our currency to function. That privilege is being revoked. If fewer dollars are needed to buy oil, there is no reason to stockpile US treasuries. This aligns perfectly with China's bond liquidation. It's a pincer move, pressure from both sides. On one side, China floods the market with bonds. On the other, they reduce global demand for dollars. The squeeze is on. Investors are waking up. They are demanding higher yields because they see the truth. The US government has no credible exit plan. The strategy in Washington is simple. Borrow more to pay the interest on existing debt. In any other context, that would be called a Ponzi scheme. And Ponzi schemes only work until the biggest investor walks away. China has walked. We are already seeing the cracks. Treasury auctions are failing. When buyers don't show up, primary dealers, big banks, are forced to absorb the debt. Their balance sheets are choking. Liquidity dries up. US treasuries are the collateral of the entire global system. If that market freezes, everything freezes. ATMs, credit cards, trade. The Federal Reserve knows this. They are terrified. They talk about slowing quantitative tightening. But that's just delay. It doesn't solve the problem. The real problem is simple. The government spends too much. It relied on foreign lenders to fund it. Those lenders are gone. So the bill gets paid with inflation. Inflation is a tax you never voted for. You feel it everywhere. Gas, groceries, insurance, rent. Prices rise, not because companies are greedy, but because the currency is weakening. China understands this game. They are forcing America to choose between hyperinflation and depression. And history shows politicians always choose inflation. It hides the pain. So here's what comes next. The Federal Reserve will eventually panic. They'll restart money printing. They don't all dress it up with a new name. Market stabilization or liquidity support. But don't be fooled. It's currency debasement. This will temporarily rescue banks and markets, but it will permanently damage the dollar. This is why stock prices appear strong. Not because companies are thriving, but because money is losing value. It's the Venezuela effect. Markets rise in nominal terms while real purchasing power collapses. The stock market isn't going up. The dollar is going down. And the so-called safe asset of the last 40 years, the US Treasury bond, is now the danger zone. The 60-40 portfolio is finished. Stocks and bonds are falling together. China exposed the flaw at the heart of the system. The risk-free rate was never risk-free. Other nations are following. The BRICS bloc is building alternatives. New payment systems, new settlement mechanisms, gold-backed trade. Central banks are hoarding gold at the fastest pace in half a century. This isn't about nostalgia. It's about survival. Gold cannot be frozen. It doesn't rely on another government's promise. In a world of financial warfare, neutrality is everything. China is leading the shift, but they aren't stopping with gold. They're buying real assets, copper mines, farmland, energy infrastructure. They're converting paper claims into physical control. This is what smart money does before a reset. Look at your own balance sheet. How much of your wealth exists as digits inside a system you don't control? If your net worth lives in a bank or a retirement account, you are exposed. The everything bubble was built on cheap credit. The collapse will be driven by expensive credit. That is gravity. Interest rates at 6% cannot coexist with record stock valuations. One of them has to break. That's why insiders are selling. They are moving down the risk pyramid, out of speculative assets and into tangible ones. You need to become your own central bank. That means holding reserves outside the system. Here's the rule of the next decade. If you can't touch it, you don't own it. A gold ETF is not gold, it's a promise. And promises break in crises. China understands this. They take physical delivery. They repatriate their bullion. They are draining vaults. Soon, there will be two gold prices, the paper price and the real price. The gap will explode. We are already seeing this in silver. Housing is not immune. Real estate is a hard asset wrapped in a debt bomb. If you own your home outright, that's protection. If you're heavily leveraged, it's a liability. Even fixed-rate mortgages aren't safe. Insurance costs are exploding. Property taxes are surging. These are stealth variable rates. Local governments are broke. Empty office towers aren't paying taxes. Cities will squeeze homeowners to fill the gap. Your house is becoming a tax farm. You need flexibility. You need assets that remain liquid in crisis. Cash is not liquidity. Cash is fuel for inflation. Liquidity is owning something that holds value everywhere. Gold does that. It works without electricity, without permission, in war, in collapse. China is building a wall of gold. You should pay attention. Build a wall around your family. Do not wait for the Federal Reserve to warn you. They never will. By the time they admit there is a crisis, the exits will already be closed. This is where central bank digital currency enters the picture. CBDCs are the endgame. Total surveillance, total control. They allow governments to track every transaction, restrict what you buy, and impose negative interest rates, penalties for saving. This is financial repression. They need you trapped in the system so they can inflate away the debt. If people escape the dollar, the strategy fails. That's why restrictions will come, but not yet. Right now, the door is still open. You can still convert digital numbers into tangible assets without punishment. No limits, no barriers. But this window will not remain open forever. The $850 billion liquidation by China is only the first domino. It will topple bonds, then stocks, then the currency itself. We are watching the collapse of an old order. The transition will be chaotic, volatile, violent in financial terms. But wealth is never destroyed. It moves. It transfers from the unprepared to the prepared, from those holding promises to those holding real things. You have a decision to make. Will you be the creditor who gets repaid in worthless paper, or the owner who holds assets the world actually needs? China has already chosen. They are betting against the dollar. They are betting on mathematics. You should examine that bet carefully, because math always wins. The storm is not coming. It is here, above you. The roof is already leaking. Build your ark. Stock it with hard assets. But knowing what to own is only half the equation. Timing matters. There is one specific red line indicator that shows exactly when the Federal Reserve is forced to print again. It has signaled every major crisis since 2008, and it just turned red this morning. Click the video on screen to see the chart that terrifies the Fed. I'll see you there.